Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a pretty popular stock in the stock market that could be trading at a really good buying opportunity right now. And that stock is Dropbox. And we can see over the last year, the stock is only down around 10%, while the rest of the market is down close to 20%. So they are outperforming the market at the moment. And so in this video, I'm just going to look into some of the recent news that's come out surrounding Dropbox, look at their financial statements, and then figure out the intrinsic value per share for their company to know if this is a good buying price to buy into the company from a value investing perspective. And so right into the news here, we can see Dropbox recently acquired a company called Boxcryptor to help enhance their service and make their service a little bit safer to use. We can see they point out that Dropbox is really well known for their cloud-based file backup and sharing services. And while the service does offer encryption for files when moving files between servers and destination, Dropbox actually has access to the keys, and so they're technically able to view any of the content passing through. And so this acquisition of this new company, Boxcryptor, basically enhances the product and the value proposition they're offering to their customers by making it so that the files are a little bit more confidential and they're encrypted before they even arrive, which is one of the main concerns that some customers were bringing up about Dropbox's service, but this obviously fixes that problem. Also, we can see in this article right here, they talk about how Dropbox might be, some reasons why they might be a good investment. In particular, right here, they talk about how Dropbox remains one of the best performing software as a service stocks for the year, down only single digits versus 30 to 40% declines from many of their competitors. Also, they have a strong free cash flow profile, and at the moment, they point out that the company is well priced at around 10 times forward free cash flow. So right here, we can see these are their financial statements. This is their balance sheet here comparing September 30th, 2022 to December 31st, 2021. And during that time period, we can see their total assets have decreased from around $3 billion to $2.7 billion. We can also see that they have a lot of debt sitting on their balance sheet, and they actually have negative stockholders' equity, a stockholders' deficit, mainly as a result of historical operating losses right here in their accumulated deficit line item of around $2.9 billion total over their total operating history. Then right here, we can see their income statement comparing the third quarter results for 2022 to 2021. Year over year, their revenues have increased from $550 million to $591 million. So that's an increase of around 7% year over year. They actually also had around 17.5 million paid users, which is up from 16.4 million users year over year. And their average revenue per user was around $134 this year, compared to only $133 last year. So not only have they increased the amount of users they have for their company, but they've also increased the amount of revenue they're producing per user for their company. And if I scroll down here, we can see net income year over year increased from around $75 million to $83 million. So they are profitable during the third quarter of 2022, and they were profitable so far for the first 9 months of 2021 and 2022 as well. So as long as they're able to continue these historical operating profits, they'll eventually eat away at that accumulated deficit on their balance sheet. Right here, we can see this is their statement of cash flows comparing the first 9 months of 2022 to 2021. And during that time period, operating cash flow for 2022 was around $602 million. And of the $602 million, around $251 million of that came in the third quarter alone. And we can also see they repurchased around $621 million worth of common stock. So that's definitely a ton of value returned to shareholders, but that is down from $763 million of common stock that they repurchased in 2021. And so now right here, we can see this discounted cash flow model to figure out the intrinsic value per share for their company. Yahoo Finance estimated that they're going to grow at around 8% for the next 5 years. They had around $739 million of free cash flow in 2021, around $830 million worth of debt on their balance sheet after netting that against their cash. And they had around 280 million shares outstanding, which puts their intrinsic value per share at $35 per share, which means that at the current share price of $22 per share, they're basically trading at around a 30% margin of safety relative to their intrinsic value per share, which is a pretty good buying opportunity. They're actually trading at an even cheaper price at the moment than they were when they went public in around 2018. So definitely could be a good buying opportunity if they're able to grow their future cash flows at the projected growth rates of around 4 to 8% here. And so on the right hand side here, I compared them to some of their competitors. It's pretty difficult to compare them to their competitors because Dropbox is mainly a service that's used to allow the storage and file sharing of different files backed up by cloud users on all devices. But Google Cloud, or not Google Cloud, but Google Drive and OneDrive with Google and Microsoft, they also provide that service. But obviously, Google and Microsoft offer a lot of different services aside from just this service, which is competitive with Dropbox. And so comparing their profit margins to the profit margins for Dropbox isn't really a direct comparison because you're comparing all of Google and Microsoft services versus just Dropbox's one main service. And then also there's another company called Box that does something similar to Dropbox here as well in this industry. And so we can see across the board that Dropbox has the highest gross profit margin, but they have the third lowest net profit margin behind Microsoft and Google. And then also same thing with return on assets. In terms of PE ratio, they're about middling of the pack, above Google, but below Microsoft. And the only company that paid a dividend was Microsoft at around $2.48 per share. And then we can see all across the board, Box is not a profitable company. So they don't really have net profit margin, return on assets, or price to earnings ratio, or dividend per share because they didn't pay a dividend. So I would say from a competitor analysis perspective, it looks like Dropbox could definitely improve on their net profit margins, but in terms of gross profit margin, they're obviously dominating Microsoft and Google. If I was going to choose a company to invest in from this perspective, it would obviously probably be Google or Microsoft, just because Microsoft is paying a dividend, whereas the other companies are not. They also have the highest net profit margin, but Google is also trading at a pretty attractive PE ratio relative to the other companies. But from an intrinsic value perspective, we can see Dropbox is trading below intrinsic value per share at the moment, right around a 30% margin of safety. But clearly, as a result of their operating history here with their stock price, we can see they haven't really shown historical evidence that they can produce a positive, growing stock for their shareholders at the moment. So it'll be tough to say whether or not Dropbox will be able to turn that around in the future. But at the current share price, if they are able to continue to grow their free cash flow, then it could present a strong buying opportunity potentially. But I'd love to know what everyone watching this video thinks about Dropbox. Is it a good buying opportunity at the current share price? Let me know in the comment section down below. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.